Hello everyone, welcome to this educational presentation of how to easily identify high probability entry setups. Now in today's educational webinar, I'm going to show you a couple of components that you can quickly apply to any trading, no matter what direction, no matter what market you're trading, or no matter what time frame. I'm going to show you a lot of examples. Now as of late, we've had a very volatile market. The Dow Jones and the S&P have really had some really tremendous swings, either up or down, and a lot of traders, some of our students or prospective students, have had difficulty maneuvering their way around these markets. And my mentor said, Steve, just get rid of all this useless data and make things simple. And they showed me the simplest of things, and guess what? They really work. The simpler the technique you use, the simpler the method, the more valid it will be, in my opinion. So you're going to see how simple these components are, but I'm going to show you examples of just how powerful they can be. For example, component 1 states that buy signals, regardless of what strategy you have, I don't care if it's one of my strategies or one of yours, if you get a buy signal, it can only be entered above the 50-period moving average. Okay? It's as simple as that. So in other words, if you have a signal service or your system which you've developed, or maybe you spent $10,000 on, generates a buy signal, it must be above the 50-period moving average. I don't care what time frame, if it's a 5-minute strategy signal, if it's a monthly. Plot a 50-period moving average. Your entry should only be above. Now conversely, if you're going short, if you like to buy puts, you can only go short and enter below the 50-period moving average. I know this seems just too simple. I know this seems ridiculous, but trust me, if I were stranded on a desert island and if I could only use one trading technique that I've accumulated in my 4 decades, it would be this, because this component has kept me out of so much trouble, and it's helped me to be consistent more than anything else. Let me show you what I mean here. Let's look at an old chart of the spiders. This is a weekly chart. This is before the market really decided to correct here just this past month. Someone looking at this would say, gosh, you know, I wish I had known we were just going to go up and make these new benchmark highs, because I had no idea the market was going up and I didn't sell into it, but I exited my positions way too early and I didn't take advantage of buying it. How would I have known though? I mean, you know, there's no way to know, right? Well, that's not true. This is a weekly chart of the spiders. Let's apply the 50-period moving average. Now we can go back and look over a year, where has price been in relation to that 50-period moving average? Price has always been above. So don't you think the odds are in your favor if you're only buying above that 50-period moving average? Sure, you had a sell-off right here that on a weekly time frame would have generated a short quick profit, but you would have had to been very quick to cover and to get out. Don't you think it would have been more advantageous to look for buying opportunities on this sell-off and then look for buying opportunities here and buying opportunities here? See how the odds are in your favor if you only are a buyer above the 50-period moving average. Now conversely, let's look at this older chart in DKS. All right, this is the way most traders trade. All right, they'll see something that is oversold in their opinion. In other words, they either went to a chat room or they looked at the earnings and they said, boy, this thing is too low. All the indicators I track say this stock is tremendously oversold. I mean, look, we have a gap down right here. We're trying to hold on. So this is what usually happens. You see, okay, this is the second gap and now we're having a series of updates. I'm going to buy right here. All right, the institutions are all heavily buying this. The guy in the chat room loves this stock, so I'm going to be a buyer too. So it bounces for a little bit and then it goes much lower. So at this point you say, boy, it didn't really bounce. I thought it was so oversold, but if it was oversold here, it's really oversold here, right? And this is a major Fibonacci support level. This is a major Elliott wave support level, and all the institutions are just doubling up buying here. So I'm going to be a buyer too. So it goes up for another couple of weeks and then look what happens, okay? This is the way most traders trade. This is the way most traders lose, and why 85% of all traders fail is because you're buying when you should be selling. But most traders would say, well, how would I know I should be selling? The thing was so oversold. Well, it's as simple as applying the 50-period moving average. Ask yourself, where has price been in relation to the 50? It's been below. So I don't care what some guru says on TV. I don't care what the institutions are doing. I don't care what some economic report says. If price is below the 50, you should only be selling. You're going to increase your odds for consistency so much more if you apply this simple rule. And the beauty of it is that it doesn't cost you anything. I'm not here to sell you some $10,000 system. You can start doing this right now. Whatever platform you have, I'm sure has the capability to generate moving averages. Just plot a 50-period simple moving average. But please remember, this is not a system. So many students love this, and then the minute they see it, they start applying it, they use it as a trading system, meaning that the minute price trades 1 or 2 bars above the 50, they buy at the market, or they sell at the market if it's below. That's not the proper application. It's just meant to tell you whether you should be looking at the market from a buyer's perspective or a seller's perspective, okay? So in order to find out, I have a homework assignment for you, all right? I bet you didn't think you were going to get homework on a Saturday morning, but go back and research your last 10 to 20 trades. And it doesn't matter if you're a swing trader, it doesn't matter if you trade currency pairs or you only trade Bitcoin, it doesn't matter if you're an intraday trader of futures. It makes no difference what time frame, what market, but apply a 50-period moving average. I can almost guarantee you that if you look back at your last 10 or 20 trades, the reason you had losses were because you were out of sync with the 50-period simple moving average. In other words, you were buying below the 50 and you were selling above. Now sure, every once in a while there'll be a great signal where you could have called a bottom that was below the 50 and picked the exact bottom, or you could have called the exact top. Sure, that happens every once in a while. But remember, trading like that, trying to pick tops and bottoms, is comparable to the slot machines in Las Vegas. They're designed to give you a winner every once in a while, to give you this false sense of security that, hey, I'm doing pretty good. And all the bells and whistles go off and you see the clinging and clanging of the coins and you think you're doing all right. But if you stay at that slot machine long enough, they're designed to actually wipe you out. And it's the same way when you try and buy and sell in the opposite manner of the 50-period moving average. Sure, you'll get a great winner every once in a while, but it's not going to sustain you. And remember, everything we're trying to teach is the ability to sustain you as a trader, not just for a couple of years or a month, but for 10, 20, 30, 40 years down the road. That's my goal, to keep you trading for 40 years, not just to have you have a great year and then you lose everything and give it all back. Okay, so that's component number 1. Extremely simple, right? Well, let me show you component number 2, even simpler. Whatever strategy you're trading doesn't make any difference. I don't care if it's based on one of my methods or if it's based on the full moon. It absolutely makes no difference. But if you get a buy signal, it should be above the 50-period moving average. In other words, you should be entering above the 50-period moving average, and that bar that generated the buy signal, whether it's a daily bar, a 5-minute bar, a weekly bar, it makes no difference. It must close in the top 25% of its range, okay? So in other words, whenever you're trading, let's say you're basing it off of news, once that bar closes, whatever generated your buy signal, it must close in the top 25%. Now, if you don't know what that means, let's just look at this generic bar here. I on purposely took out what it was and what time frame because it makes no difference. But if you're looking at a bar, you look at the range. Now, the range is not, for some reason, people think the range is open to close. I don't know why that's come to mean the range these days. The range is the extreme high to the extreme low, okay? That's the top of the wick to the bottom of the wick, if you prefer. And you just divide that by 4 separate equal parts. And if you close in the top 25%, and if you are above the 50, that is your signal bar. That's where you buy. And you have to wait for that. So let's say you get a buy signal, say it's based off one of your strategies, and the bar closes, say it's based on an hourly bar, and the bar closes above the 50-period moving average, but it does not close in the top quarter of its range. Well, you don't buy it yet. Don't buy it yet. Don't wait. Wait for the first bar that closes in the top 25%. That's your clue to get in. And people say, well, why? What does that matter? Because that's a clue coming from the market. It's telling you it wants to go higher. So that's when we jump on board. You see, we don't listen to guys on TV or guys in webinars. We don't care what they think because we know they have no more consistency than anyone else. We take all of our cues from the market. That's the source. That's what you're trading. So why listen to anything else? Learn to listen to the market, and that's what you should be making your decisions based off of. All right, now conversely, if we're going short, let's say we're buying puts based on some strategy. Okay, we're below the 50-period moving average. That means, all right, we're on the right side. And let's say our strategy, whatever it's based on, maybe it's based on the tides of the ocean. Makes no difference. Everything comes to play and it generates a sell signal. Well, you can't sell until you see that first bar that closes in the bottom 25% of its range. Okay, that is your cue then to jump on board on the short side. For example here, let's say we're below the 50-period moving average. We see a bar like this. The open to close range is not the range. The true range is the top of the wick to the bottom of the wick. You divide by 4 separate but equal parts, and if you're below the 50 and if you close in the bottom 25%, that is your sell signal bar. That's the bar you sell. Purchase puts, whatever you want to do, okay? Let me show you how we could have applied these to these charts we looked at earlier, all right? Let's look at this. Now, there are a number of bars that closed in the top 25%. I'm going to show you 4 that were highly profitable and consistent, okay? Same thing with DKS. We're below the 50, and look at all these sell signals that were generated. The bar closed in the bottom 25%. I know you're probably asking, well, wow, how did you just pick out these ones from all the others? Because there are other bars that close in the top or bottom 25%. How would you know which one of these to pick? Well, this is what we're going to be talking about today. I just shared with you 2 of the rules of a 5-rule strategy, and that's one of our most consistent. It's strategy number 4. I have been trading this strategy on a daily basis in some capacity for the last 4 decades. I traded it on Friday. Just about every day I will use these 2 components in my trading along with the other rules. Let me explain with you some of the highlights behind strategy 4. It's for all traders, beginners to advanced. It makes no difference if you've been trading 50 years or if you're trading 50 minutes. Everyone gets the same basic format as a member of the strategy number 4 course. And then we work out from there. If you're the type of trader that likes to trade 20 times a day, then we show you ways in which to do that. If you're also the type of trader that's very conservative, only wants to trade once a week but wants to keep your risk as low as possible, we show you different variables and options and ways in which to do that. It's up to you how you want to implement the trade. If you want to buy the stock, if you want to buy the future, if you want to purchase options, it's up to you. Remember, we're not in charge of your trading. You're in charge. We just simply give you the variables and then work with you so that you can feel comfortable and say, you know what, I've been following this guy and he trades 100 times a day. I can't trade like that. This is the first time I've been able to trade what makes me feel comfortable. That's how you become a consistent trader, when you feel comfortable trading your own method, all right? Now, it was originally designed for traders looking to catch quick momentum moves. When I first used this 4 decades ago, I was in and out in a matter of minutes because I was on the floor making trades. But now we've devised ways in which you can stay in the trade days, weeks, even months if you'd like, all right? Its intensity level, if 1 is the most intense of all strategies you've ever seen, where you can't even leave your computer to go to the bathroom, and 3 is the most relaxed, where you basically enter your orders and come back next week, it's a very moderate number 2, okay? It's right in the middle. It only uses 1 indicator. That's how simple this is. And guess what? You already know what it is. It's the 50-period simple moving average. It's a pattern recognition type of strategy. You've already gotten 2 pieces of the puzzle. There are 3 pieces that are still left out that I can't divulge right now. It wouldn't be fair to the people that have already paid for the course. But I share with you 2 of the most basic and powerful rules of this. The beauty of strategy 4 is that it can be applied to any time frame, any direction, and any market. Now, the majority of the examples I'm going to be sharing with you today are stocks, but I'll also show you some futures, some E-mini futures. I'll show you some currency pairs as well. So it makes no difference. This was originally designed to trade stocks, but it virtually can be applied to anything. We have people who trade this on commodities. We have traders who swear by this on 10-minute currency pair charts. So it makes no difference. That's how consistent it is. Now, if you're a member of our course, you receive automatic educational buy and sell signals. So what do we mean by educational? Well, in the online courses, I teach you how to spot this specific pattern that makes up the setup for strategy number 4. And my goal is to have you get to that point where you can automatically see it. For example, when I look at a chart, I automatically know, just by looking at the chart, where a strategy 4 buy or sell signal is. I don't have to do any work. I automatically can see the pattern. All right. I want to get you there. But while you're getting to that point, you need to practice. You need to check your work. So what we do is we teach you what to look for, and I want you to go to a chart, see if you can spot a strategy 4 signal, and then use the educational buy and sell arrows to check your work. If you think a buy signal was generated in Snapchat, all right, on Friday, I want you to click on the up and down arrows and see if a green arrow was placed underneath there. If it was, well, then you validated your homework. If not, well, then something's wrong and you're not learning. This is why we say everything is for education. Now, our edge here is consistency. What does that mean? It means you will have small losses from time to time, but that's okay. That's perfectly normal. Don't let anyone ever tell you that it's wrong to lose. That would be like someone telling a baseball player it's wrong to strike out. Every baseball player, the best of the best, have all struck out. Michael Jordan missed every basketball shot, okay? Frank Sinatra didn't have a hit record every time, or singers don't have a hit record or album, or movie actors or actresses, Robert De Niro doesn't always have a hit movie. It's totally normal to have a little slump. What you want to have is some method that brings you consistency so that when you have a little series of small losses, you're able to make them back very quickly. And that's the beauty. That's what will sustain you. Not fly-by-night system that costs you thousands of dollars and has a pretty good track record, but then when you trade it, maybe only has one good trade and then goes into a tremendous drawdown. That's not what you want. You want a two-step forward, one-step back approach. Okay, let's share with you some examples here. Here's an example of STT, all right? This happened at the beginning of January, just a few months ago. Now, someone looking at this would say, Steve, how can I trade this, all right? The chat room I go to says you never want to trade a rangy market. And this is a total range. In fact, we're not doing anything. We're basically just going sideways. And that's where you lose money. And secondly, I looked at the earnings, and the earnings are going to be really bad. The estimation is not going to meet expectations. So I don't think I want to buy this, okay? I don't understand why you would think this would be a buy. Did you see all the rationale I made for not buying this? This is the way 99.9% of all traders trade. It's always based on an outside source, what the estimations are, the earnings, what some chat room is saying, but it's not based on what the market is telling you. And what's the market telling us? Well, the first thing is the market's telling us it's above the 50-period moving average. You can just see right here. How would we find out? Well, we click on our buy-sell line. Excuse me, I backtracked there. You click on 50-period moving average, and automatically you'll see that price is above. Okay, this is all the ease in which we've made everything for you on our new PTS Primo charting platform. So if price is above, sure, the stock may not be going anywhere for the last month or two, but you should not think about selling it because it's above the 50 and it's telling you most likely it will be going higher until it closes below the 50 on a consecutive basis. And then what do we have here? We have a bar that closes in the top 25%. All right. Now there are other bars that close in the top 25% here and here, but unfortunately they did not meet the remaining rules of the strategy. I'm sorry, once again, I can't divulge what those rules are. It wouldn't be fair for the people who are already course members. But I've given you two rules, and trust me, this met all of the other requirements. So in order to check your work, you would simply come to the platform, click on strategy number 4. You'll get a drop-down menu again and click on signal arrows to check your work. And guess what? There was an up arrow there. So now you have the confidence to know that you've correctly spotted one, and now you have a high probability setup for the market to go higher. Do we know how much higher? No, we have no idea. It may go up 1 point, may go up 5 points, may go up 10 points. We don't know. But we show you in the course different exit points, different points in which to move your stop to unchanged, different ways in which to track the trade. How you decide to use it is entirely up to you. We're not going to tell you where to get out. We're not going to tell you how many shares to trade. It's your call. We're just sharing with you all this important information. And had you chosen to go long STT at the beginning of January, well, guess what? 16 points in 3 weeks. Not a bad trade, huh? And you could have done this yourself. You wouldn't have had to pay for a signal service. You don't have to pay for some guy that's, some blog or something you subscribe to, or don't have to wait with bated breath what the news events are. The market tells you what it wants to do. You just have to learn how to listen to the market. All right, so let's look at some stock examples, and then we'll move on to other markets. But let's look at the last 3 months from December all the way till the end of February, okay? And we're going to start out with buys because the beginning of that period was strongly to the upside. Sure, there were some sell opportunities I'll show you, but the majority of setups were for going long because everything was above the 50-period moving average. For example, in BY, we are above the 50-period moving average. We have a bar that closes in the top 25%. All right, a buy signal is generated, and the stock gained 10 points in the remaining 2 weeks, okay, coming into the end of January. In MAR, we have 3 buy signals. We're all above the 50-period moving average. As you notice, here's component number 2. Each of one of these bars closed in the top 25%. The remaining rules of the strategy are met, And had you purchased this very first buy setup, that would have been 22 points that you would have been able to work with, potentially capture, okay? Once again, it's up to you. If you wanted to take 1 point and get out, that's great. It's your choice, not ours. If you wanted to take 10 points, it's up to you. You are in charge of your trading, not us. How about Triple L? The same thing. We're above the 50. We crossed above the 50 in late November. So someone saying, well, you've got to sell the market. Why? We're above the 50. 3 buy signals have been generated. Nothing much has happened yet. This is an expensive stock, but you could have purchased calls if you wanted to. And if you hung in there through the month of January, that would have been 24 points in your favor to the upside. How about CSRA? This is a little bit more advanced. We are originally above the 50-period moving average, but now we start to oscillate, and then we close entirely below. But the next bar closes above. Remember, the rule is you can only enter above the 50-period moving average. So even though we had a previous bar close below, this bar closed above the 50 and in the top 25%. So it actually is a valid buy signal. Although it's a little bit advanced, a little bit more aggressive, that's okay. But if you take advantage of that, well, the stock gained 10 points in 3 days. Now, obviously, it gapped up strongly based off some news or some event. Did we have any idea that that was going to take place? Absolutely not, because it's not required to follow any type of fundamental news or announcements. We don't, that's not the market. Remember, we're only concerned about what the chart in front of us is saying. That's all we want to keep it simple. We don't want to let discretion come in and try to figure out what something means. So regarding what we teach you, sure, it may have gone up a couple of points, maybe 10 points, but the point is the CEO of the company did not call me up and tell me to post a buy signal. The market told me that it was a buy signal. Same thing with GWW. We are coming down close to the 50-period moving average, but we have a bar here that closes in the top 25%, and in 3 days, 70 points to the upside. Once again, we had no idea. Now, you could have exited on this opening here, taken a quick, I believe, about 30, 35 points, or held out longer. It's up to you, but we show you different exit levels and different exit plans for you to decide. All right, let's look at sells now. We talked about the buys. Let's look at sells. Obviously, the sells were starting to happen right around February when the market topped out. Now, traders love to play the victim game. They say, boy, that sell-off came out of nowhere. I could have never taken advantage of trading anything or going short, or at least getting out of my positions. Well, I'm here to tell you that you're wrong, because the market was giving you a lot of clues to get out. Let me show you right here. Here's XLNX. We are above the 50-period moving average, and then we closed below. So this is the same thing. Even though the majority of bars close above, we have a close below, and we close in the bottom 25%. So this is a little bit more advanced, but it's still a valid signal. It met all the criteria, and the stock fell 9 points in 4 days in the first week in February. Now here's an example in AIZ where we talk about consistency. Remember, where you will have small losses from time to time. This was at the beginning of January. This is when the market was taking off, starting to make new highs. Sell signals were being generated in AIZ. We are above the 50-period moving average, but we have a bar here that closes in the bottom 25%, and it just barely closes below the 50. So if you had elected to go short, well, you most likely would have been stopped out, because the next 3 days it went higher, and then it even went higher fourth or fifth day. All right, that's okay. Don't just sit there and lick your wounds. If you're applying proper money management, you have the right risk-reward control that we teach you in the course, it's okay, because the odds are that with a consistent method, you're able to recoup it, hopefully quicker, sooner than later. So if you had, gone in and played the pouting game, you would have missed an opportunity to go short again a week later, because 2 more sell signals were generated, and this time it kicked in 14 points to the downside coming into February. All right, so when the market was making new highs, AIZ was making new lows. So you could have quickly recouped that loss and then made some more. This is what we mean by consistency. 2 steps forward, 1 step back. And if you miss that, well, guess what? The market is always giving you more chances to get back in. 3 more sell signals were generated while we were going lower. Okay, McDonald's, MCD, same thing. We're above the 50-period moving average. This is where beginning students say, Steve, how can I sell this? Because the majority of bars are above the 50-period moving average. Well, that's correct. But remember, the setup bar, the bar you sell on, is the only one we're really concerned with. So this bar closed below the 50 and it closed in the bottom 25%. So even though it's a little bit more aggressive, it is a valid sell signal. And if you had taken advantage of that, it would have been 18 points in your favor to the downside the first week of February. See, you had a lot of chances to go short and make some very quick gains to the sell side just a month ago. But most people love to play the victim and say, gosh, I didn't see that sell-off coming. You know, God, who would have known? I really, got hurt holding on to my positions. Well, if you use the two components I'm sharing with you today, it could have really helped you to be a consistent trader this past few months. How about EXPE? Same thing. We're above the 50. We have one bar closing below. All right. Now, we realize another expensive $100 stock, but you could have purchased puts. But this was in the first week, the end of the first week in February. The market had already started to sell off, but the large sell-off to the downside hadn't occurred yet. So a lot of people say, boy, I would have wished I could have taken advantage of some stock that fell out of bed during that $1,000 drop. Well, you could have. EXPE generated a sell signal. You could have purchased puts, or if you were lucky enough to go short right before the close because the stock gapped down 25 points the next day. All right. Did we have any idea it was going to gap down that much? No. Did we listen to the CEO or did we listen to an announcement? No. We only listened to the chart in front of us. The chart tells you just about everything you need to know. Why overcomplicate your trading? Why feel that you have to listen to someone tell you what to do? The market tells you what it wants to do. All we have to do is just jump on board. PSA, same thing here where we're talking about consistency. Now this is going back to December of last year, well before the market sold off. We were getting multiple sell signals. Here, the first one that was generated at the end of last year would have generated a loss, okay? Nothing happened. We went short. You could have purchased the puts, and then it quickly went up. Most likely you would have been stopped out with a standard stop. But the next couple of weeks generated three more sell signals. Now, had you taken each one, nothing much would have happened until the beginning of January. Well, then it kicked in, and you had 27 points that you could have potentially taken advantage of. And once again, if you missed many times, there are more signals generated along the way. All right, so let's look at some other markets. As we know, we focus mainly on stocks, and not everyone trades stocks. That's okay. This can be applied to virtually any market, any time frame. So let's look at an hourly chart of the E-mini futures, okay? As we can see here, we are oscillating above and below the 50-period moving average on an hourly time frame. This was the first week of February, okay? This is an hourly chart of the E-mini. The same rules apply. We're looking for a bar that closes, in this case, below the 50. It closes in the bottom 25%, and the remaining three rules of the strategy are met. Okay, when we say bottom 25%, we take the top of the wick to the bottom, and we divide by 4 if we close in the bottom quarter, and the remaining rules are met. That's a valid sell signal, all right? Now, is this sell signal based off economic news? Is it based off some dogma such as, something you've heard before, like what the institutions are doing, or maybe support and resistance or Fibonacci levels? No, not based on any of those things. This is a specific pattern that is translating what the market wants to do. That's it. You see, our job as traders, I've often said this, is simple. It's twofold. There's only two things you have to do. You have to listen to the market, find out what it wants to do. When we say what it wants to do, we mean like what direction. Does it want to go up? Does it want to go down? Does it want to go sideways? And once you learn how to decipher that, then add a little structure and jump on board. In other words, imagine the markets are like a river. All right? You walk up to the river and you find out which direction it's going. Is it going south? Is it going north? And if it's going in a certain direction and now you understand that that's where you want to go, then you put a little structure together to ride the current. You can either get a raft, you can get a boat, you can get an inner tube. It makes no difference, but that's the structure. That's what a strategy is. All right. Here's the way most traders trade. They go up to the river, they don't have any idea which direction it's going, and then they jump in and swim against the current and think that that's what's going to get them somewhere faster. And that's a recipe for disaster. Remember, 85% of all traders fail. It's because they're swimming against the current. Just listen to the market, what it's telling you, and jump on board. It doesn't have to be any more complicated than that, okay? So the market's telling us it wants to go lower. This was in February, the first week of February, February 8th actually, and look what happened. You could have taken advantage of that large move to the downside. You had potentially 115 E-mini points to capture. That's over $5,500 per contract. Now, I'm not saying you would have stayed in that long. If you wanted to get out with a quick point, that would have been fine. There's no right or wrong way to trade. The only wrong way to trade is when you are following someone else, when you're mimicking another trader. That's a recipe for disaster. So that was an hourly chart in the E-mini. How about a 4-hour chart of the euro dollar? We have a lot of currency pair traders here. All right. First rule, where is price in relation to the 50 period? Price is above. So that means we're only a buyer on a 4-hour time frame of the euro dollar. I don't care what the economic reports are. I don't care what somebody's saying in the chat room. You're only going to be a buyer. Okay. Now 4 signals were generated to go long. Nothing much happened. This was in mid to end of January. Okay. But had you stayed in, maybe you would have got stopped out with a small loss here. But if you took the next 2 here coming towards the end of January, you could have potentially made back everything you lost on the first one and about 250, 300 more pips to cover that loss and to have a little profit. Okay. Now, lastly, we know we have some interest in Bitcoin. I know that was the darling of the trading world last year, and it's kind of softened now because it hasn't done much. It's gone into a sell-off. And a lot of people saying, boy, I didn't realize that that was so volatile, and I purchased Bitcoin, and then I lost a ton of money because it fell out of bed. Well, here's a daily chart of Bitcoin. We knew well in advance, because price was below the 50, that you shouldn't be long this. Once it crossed below the 50, in whatever time frame you're looking at, you should be out or else looking to go short. Now, if you're an aggressive Bitcoin trader, you could have used strategy number 4 on Bitcoin. As you see here, this was in the mid to end of January. We're below the 50. We closed in the bottom 25% on this day, and it met all the other requirements. And so look what happened to Bitcoin, 5,000 basis points to the downside. So you've just seen that this can be applied to any market, any time frame, and you can use it to trade, but you can also use it not to trade, but as a directional tool. For example, in the QQQs, a buy signal was generated at the beginning of January in the QQQs, which is the ETF that represents the NASDAQ 100 index. Now, even if you didn't want to buy or purchase a QQQs or some type of option, you could have said, well, listen, it stands to reason that if the ETF that represents the NASDAQ index is generating a buy signal, wouldn't it mean that the index is going to go up and all the stocks that make up that index? So you could have used this to purchase something that makes up the index or a prominent stock within the NASDAQ. So that's another way. It can be applied as a market directional tool. You can apply it to indices and then trade things that make up those indices. Okay, so before we go into question and answers, I want to recap with you what we just shared with you and the 2 educational things we taught you today. First of all, always apply the 50-period moving average, okay? If there's one thing I can stress today, it's you must have a 50-period moving average applied on your chart. And ask yourself, where is price in relation to that? If price is above, you're only going to see the market as a buyer. I don't care what someone says in a chat room or on TV. I don't care what the earnings are. Over time, if you use this rule, it will save you so much money and get you on the consistent side. And if price is below, you'll only be a seller or you'll only be out of the market. Never buy below the 50 and never sell above the 50. Now let's say you're in sync, all right? Then you want to apply component number 2, which you want to look for a bar that closes either in the top or bottom 25% of its range, because this is the market telling you that it wants to either go higher or lower. And that's where the race has begun, in other words, and that's where you jump on board and place your bet. Okay? Now, these are 2 of the components. These are 2 of the rules that make up one of our most consistent strategies today, strategy number 4. And the beauty of strategy 4 is you can apply it to any market, any time frame, and any direction. Okay, so before you ask me questions, I'd like to ask you something here Saturday morning. Do you think these edges could have helped your trading this past year? All right. If you're still not convinced, remember, once again, go back and research. Look at your last 10, 20 trades. I can almost guarantee you that the reason why you lost or you continue to lose is because you are out of sync with the 50-period moving average and component number 2. You're not waiting to enter or look to go short when bars close in the top or bottom 25%. Go back.